Welcome back to the Project Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We have quite a stack of sources today, and they really paint a picture of, well, stark internal conflict in the financial world. You've got this incredible optimism, almost euphoria around the AI boom driving huge investments, but then bumping right up against that, you have these spiking geopolitical trade tensions creating instability. Oh, and major banks are kicking off Q3 earnings today, too. Big day.
It really is. It's the highest of high stakes conflicts, and it absolutely defines this market moment. On one hand, the enthusiasm makes it feel like we're sprinting towards this, AI-powered utopia. But then you look at the underlying financial data, and analysts are starting to draw comparisons to systemic risks we haven't really seen since the dot-com collapse. So our mission today really is to synthesize reports from places like Yahoo Finance, Bloomberg, CNBC, try to give you a clearer picture. We need to understand where this revolutionary growth is supposedly being built and maybe just how fragile that foundation actually is.
Okay, right. So let's start with that core story dominating Wall Street, this whole AI financing structure.
Yeah.
Analysts, particularly the ones cited in that Yahoo Finance report, they seem increasingly worried about what they're calling a circular dynamic. We're seeing these big infrastructure providers, the chip makers, the cloud giants, pour massive amounts of money into their customers, who then, turn around and use that cash to buy more infrastructure from the same providers. It sounds a bit too neat.
It does sound maybe too neat. It's a closed loop, and it's built on some really staggering specific investments. I mean, look at NVIDIA. We know they're putting up to $100 billion into OpenAI. That number alone is huge. Then there's a reported $2 billion linked to xAI. Plus, they hold a 7% equity stake in CoreWeave. And then you flip the coin, OpenAI, the customer in this case, just tapped Broadcom, AVGO.
Yeah, AVGO saw that jump.
Right, to help build its first in-house AI processors. And Broadcom shares surged nearly 10% just on Monday off that news. Plus, OpenAI is dealing heavily with Oracle, CoreWeave, AMD. It's a tangled web.
Okay, but help me understand this. When NVIDIA puts, say, $100 billion into OpenAI, how much of that comes back almost immediately as guaranteed revenue for NVIDIA's chips? Because that feels less like a pure investment in OpenAI's future success and more like, like vendor financing.
That's exactly the fear. That's the heart of the concern. The investment essentially, or potentially, locks the customer into buying the provider's latest, most expensive chips and cloud services. You need them for your expanded data centers. So it can create this guaranteed revenue stream for the vendor that seems based more on the initial investment itself, rather than purely organic outside demand for whatever the customer, like OpenAI, is selling. There's an analyst tracking this, Kim Forrest, who called this dynamic very troubling. She's worried that money is just being shoved back into their customers that may be poorly spent.
Troubling is one word for it. This feels, awfully familiar. Analysts are making direct comparisons to the vendor financing issues back in the dot-com era. For listeners who maybe weren't investing back then or just don't remember the details, maybe remind us why that parallel is so chilling.
Yeah, we bring up the 2000s parallel because those original vendors, think Cisco, Nortel, Lucent, they thought they were basically underwriting their own future success. They extended billions in loans and equity stakes to these cash-strapped ISPs, the internet service providers, and they booked the revenue right away. Looked great on the balance sheet.
Instant growth.
Instant growth, exactly. But when the overall capital markets dried up and those ISPs couldn't actually generate enough profit to survive, let alone pay back the loans, well, the vendors, Cisco and the others, were forced to write off billions in debt. And that failure, that cascade of write-offs, massively deepened the Nasdaq's crash. It fell over 70% between 2000 and 2002. It was brutal.
Okay, so the core risk here isn't just potentially inflated demand numbers. It's also, as Cornell professor Karan Girotra pointed out, reduced systemic resilience. If one company in this tightly interconnected loop stumbles, the financial contagion could just rip through the whole ecosystem.
Precisely. But what's interesting, or maybe confusing, is the counter-argument you hear. NVIDIA's CEO, Jensen Huang, he sees OpenAI as the next multi-trillion-dollar hyperscale company. He defends the investment, says it's separate from revenue generation, and you have Bernstein analyst Stacy Rasgon who just dismissed the bubble claims. He said there's, quote, no better use of NVIDIA's cash right now.
Wait a second. If a big analyst like Rasgon says there's no better use of NVIDIA's cash, doesn't that kind of undercut the whole bubble comparison? I mean, why should we listen to the pessimists over the CEO and a top analyst?
That's a fair question. And the nuance, I think, lies in who is taking on the risk today compared to 2000. The big tech providers like NVIDIA, Google, Microsoft, they are largely funding these huge AI expenditures with their own strong internal cash flows. That is different from the debt-fueled build-out of the dot-com era.
Okay, so that's a key difference.
It is, however, and this is the critical distinction that someone like D.A. Davidson analyst Gil Luria points out, the customers, the AI companies like OpenAI and CoreWeave, they are taking on more debt even while they receive these massive equity investments. Luria specifically calls this levering up the truly unhealthy behavior. That's where the fragility might lie.
Ah, okay. So the weak link might not be the tech giants this time, but the heavily invested startups whose own business models rely on generating enough profit to service that new debt load, regardless of the upfront investment cash.
Exactly right. The structure is still potentially fragile because the whole ecosystem's growth depends on these AI startups not just surviving, but thriving commercially to handle their debt. And, Bloomberg noted that global fund managers are definitely paying attention. A record 54% apparently now view AI stocks as being in a speculative bubble. So you've got this incredible growth story built on potentially very shaky ground.
So we have this sort of internal financial fragility within the AI world itself, but that AI infrastructure, all those chips and data centers, they also rely heavily on, well, external political stability, right?
Yeah.
Especially for supply chains, critical materials. Which brings us, maybe jarringly, to the macro shockwaves hitting the headlines today.
Yeah, the shift from that micro risk in AI financing to the macro risk is incredibly swift today. It's stark. Geopolitical friction is absolutely amplifying market anxiety. We saw it in reports from CNBC and Bloomberg. It basically reversed yesterday's little relief rally. And look at the specific actions. China sanctioned 5 U.S. subsidiaries of South Korea's Hanwha Ocean. This was direct retaliation for a U.S. probe into China's shipping industry. Hanwha shares just plunged over 8% on that news.
Wow. And the fight over critical materials seems to be escalating dramatically, too. We saw former President Trump threaten 100% tariffs on Chinese imports. That came right after China announced a new framework restricting rare earth exports, which is a massive deal considering China controls something like 70% of the global supply of those minerals, right? It's essential for everything from EVs to defense tech.
Absolutely essential. And the market reaction was immediate. U.S. rare earth stocks, companies like Critical Metals and P Materials, they rallied sharply in pre-market trading. Investors are pricing in this urgent need for secure, non-Chinese supply chains. And it's not just future threats. Today, the U.S. actually began collecting new tariffs on physical goods, 10% on lumber, 25% on certain wooden furniture and cabinets. Those are moves that could directly raise home costs here.
It's just this cycle of tit for tat, this uncertainty. And Jim Cramer, referencing some of the CNBC reporting, seemed pretty cautious about it. He pointed out that Monday's market bounce looked like it was fueled by too many speculative stocks. He specifically mentioned quantum computing and nuclear power sectors, called it bad leadership for any kind of sustained rally.
Yeah, and all this political dysfunction, this trade war talk, combined with ongoing concerns over government deficits, it's feeding into what analysts are calling the debasement trade.
Okay, let's quickly define that. The debasement trade, for listeners, is basically a bet against governments. It's the idea that they'll spend too much, print too much money, and that traditional currencies, like the dollar, will lose value over time.
Precisely. So when investors lose faith in paper money or worry about its future value, they tend to flee to what they see as real assets or safe havens. And we saw that reflected dramatically. Gold hit a new record high. And silver actually hit an all-time high of $53.55 an ounce. Part of that was safe haven demand, but also apparently a significant short squeeze.
Whoa, a silver short squeeze. Just quickly, for folks who don't track commodities closely, what does that actually mean? How does that work?
Sure. So a short squeeze happens when too many traders have bet that the price of something, in this case, silver, is going to fall. They've shorted it. If the price unexpectedly starts rising quickly, perhaps due to safe haven buying or other factors, those short sellers are forced to buy silver in the open market quickly to cut their losses. This sudden rush of forced buying pushes the price up even faster, creating a feedback loop. It's basically panic buying driven by risk management gone wrong, and it really highlights just how anxious the market is right now.
Intense. Okay, so traditional safe havens like gold and silver are surging. What about crypto, often called digital gold? How did Bitcoin and Ether react to this U.S.-China trade tension flare-up?
The volatility there was pretty staggering too, but in the other direction, Bitcoin and Ether fell sharply. The overall crypto market apparently shed over $150 billion in value, largely attributed to these renewed trade war fears. It just goes to show that even assets designed to be decentralized, supposedly outside the traditional system, are still highly sensitive to global trade flows and political risk. Nothing is truly decoupled, it seems.
Interesting point. Okay, let's pivot now to some of the big scheduled news hitting today, Tuesday, starting with the big banks. JP Morgan Chase, JPM, and Goldman Sachs, GS, are both reporting Q3 earnings before the bell.
Yeah, and expectations are actually pretty robust for them. And it connects back, interestingly, to what we were just talking about. The market upheaval, the volatility caused by trade policies and geopolitical tension, that actually tends to drive robust trading revenue for the big banks. Swings create opportunity for their trading desks. Investment banking revenue is also expected to show a strong rebound. For Goldman Sachs specifically, the expectation is something like up 22% year over year. And speaking of Goldman, strategically, they're making moves too. They just announced the acquisition of Industry Ventures. It's a $7 billion VC firm. The idea is to bolster their asset and wealth management division, and importantly, get deeper access to those fast-growing tech sectors, probably including AI that we were discussing earlier. They want a piece of that action.
Right, makes sense. And looking beyond the U.S. banks, we're also seeing some major global expansion news, especially in Asia. And it seems largely fueled by that same AI infrastructure demand, but also the need for supply chain diversification, the very thing these trade tensions are pushing companies towards.
Absolutely. It's two sides of the same coin. Look at Google. They just announced a massive $15 billion investment over 5 years. They're building a huge AI infrastructure hub in southern India, in Visakhapatnam. CNBC is reporting this is Google's largest AI hub investment outside the U.S. That's a major signal.
$15 billion. Wow. And sticking with India, but shifting to supply chains, there was news about Tata Electronics acquiring the Indian unit of a Chinese iPhone supplier, Just Tech Precision. That sounds significant given the push to diversify away from China.
It's incredibly significant. That Tata move, reportedly around $100 million, is all about scaling up capacity in India quickly, because Apple has this goal, apparently, to source all U.S. market iPhones from India by the end of 2026. That's a huge shift.
End of 2026? Wow.
Yeah. It really shows India trying to cement its position, not just as a service hub, but as a global manufacturing powerhouse. And you can see the market enthusiasm reflecting that sentiment. LG Electronics India had its IPO today. The stock surged over 45% on its debut. It was the most heavily subscribed major Indian IPO since 2008. Huge demand.
Okay, so this really brings us right back to where we started, doesn't it? This central tension. Today feels like a moment where these enormous long-term bets on future growth, Google's $15 billion in India, NVIDIA's massive AI investments, are just clashing violently with these immediate systemic risks. You know, the circular financing worries in AI, these escalating trade wars. The question for anyone trying to navigate this isn't just if AI is the future. It feels more like how resilient is the financial foundation supporting that future, especially when political stability seems to be evaporating.
That's the crux of it. And if you want to think about the scale of belief driving this, Broadcom's CEO, Hock Tan, made a remarkable prediction. He suggested generative AI could actually grow the knowledge-based portion of global GDP from maybe 30% today to 40%. That's potentially a $10 trillion a year expansion. That's the revolutionary promise underpinning these huge physical investments like Google's data centers. But then you see the vulnerability. The trade war fear is wiping $150 billion off the crypto market in, a day? It shows just how fast global sentiment can sour, even against asset classes worth trillions. So you constantly have to watch this tension, right, between the incredible promise of technological revolution and the, frankly, fragility of the political and financial systems that are supposed to support it.
A lot to track there. Plenty for us to keep watching. We'll see you all tomorrow morning with new headlines from major financial magazines.